It was a stronger than expected number this morning for the third quarter, but in the words of Oxford Economics, it contains some, quote, spooky details. There appear to be a lot of noise from tax cuts and tariffs that may not mean slower growth ahead, but could mean different growth as some of these distortions work their way through the system. Over at Pantheon, they said, quote, strong GDP growth hides soft capital spending and massive trade deterioration. Let me show you what they're talking about here. There's the 3.5 number at the top, the 4% number for consumer spending. That's very strong, probably propelled by tax cuts, stronger wages, as well as a lot of employment. But business investment, a very curious 0.8%. Now, we did have a strong second quarter, so maybe that's a bounce back from that. Hopefully, we'll get some rebound in the fourth quarter. Government spending has continued to add to growth in the economy, both federal and state. And there's net exports with a +9 on imports, maybe companies getting in underneath the tariffs coming in, and then a -3.5 on exports and 2.1%. A lot of that imported stuff ending up in inventories. Some of that's going to work its way out in the fourth quarter somehow. And the inflation number included with the report was tame, leading Bank of Tokyo Mitsubishi to write, quote, the economy isn't overheating, so Fed policy doesn't need to go overboard with rate hikes and risk throwing the economy's engines into reverse. What does the Fed say? Well, before the number, we talked to Cleveland Fed President Loretta Mester. She told us on Squawk Box she sees slowing growth ahead, but not necessarily slow growth.
I have a forecast of a tad over 3% for the year, for this year, and I have it slowing a bit next year, about 2.75, maybe to 2 to 3. So there is a slowing, but my long-run growth rate for the economy, potential growth rate, is 2%. So we're still going to be above trend growth in my forecast at this point.
Mester says at the current funds rate, the central bank's still stimulating the economy, and the Fed needs to gradually think about taking that stimulus away. Sarah, 2.75, 3% for next year, I'd take it over a point above potential GDP.
I'm wondering if you see any clues in this GDP report about the current quarter, because that was the last 3 months. And some folks are saying, well, let's just watch what companies are saying. And the guidance has been a little shaky on factors like the strong dollar and tariffs and what they see for demand.
Yeah.
So what are the clues for the future?
Well, can I give you one clue for the present, Sarah, which is you talked about just leading into me these tech companies that are out there and they're not reporting the best results. You see it in the business. It was not a strong quarter for business and CapEx. I think that has to turn around. I think you're going to get more CapEx. I think the consumer number may be overstated. I do think we slow from here. I don't think we sustain 3.5 or the 4.2 from the second quarter, but I do think we can do 3 in the fourth quarter. And who knows, maybe that 2.5 to 3% range for next year as well, which would be a huge increase for the economy based on a potential growth rate that is really still just 1.8%.